Howdy folks, and welcome to the Daily Coin. My name is Rory, and today is Monday, August the 31st, 2015, and I have the distinct honor and great pleasure of welcoming back Mr. Eric Dubin, who is the managing editor of the newsdoctors.com. And how you doing today, Eric?
Hanging in there. Put my hard hat from the markets up on the shelf for the time being, because, bricks aren't falling from the sky today, at least. But wait till tomorrow.
Well, and it's only mid-afternoon, so we still got a little ways to go.
Hey, oil was up $3.20 some odd cents as we speak. I mean, the deflationistas are taking a break as OPEC's talking about restricting future supplies and all that good stuff. And Saudi Arabia invading Yemen. I mean, it's just another week, right?
Just another day in the neighborhood.
Yeah.
Oh, my goodness. I wanted to bring you back on, Eric, because back on January 21st, 2015, I did an interview with you. And at that time, you made a really great call, and you explained in somewhat detail about how this year was going to unfold as far as Q1, Q2, and now into Q3. And what you said, and I'm going to play that clip for you right now.
Need to just kind of cool their jets and look at the really big picture that I just outlined, because that's where we are. And that also is important to consider when one juggles the probabilities when you're trying to forecast what's going to happen, whether it's, February, things are going to start falling apart, or is it more the Catherine Austin Fitts thesis of the slow burn? And you talked a lot about that on the program. Yes. I talked to Catherine directly about it. It's kind of a hybrid at this point. I think that we're going to have the slow burn continue, but then, there's an old saying, when things start falling apart, they go slowly and then all of a sudden very quickly.
Yes.
And I think that's our most probable path that we face in the next 18 months, but with some significant, huge downside moves coming in bursts in this year, and one of them being the whole sentiment busting transition that I'm bird dogging at around the end of the first quarter and beginning of the third quarter, somewhere around there, where the debt problem that we have in the oil markets and the emerging markets debt comes and shows itself. I think that people really are not really wrapping their brains around this in the conventional finance world. And it's important to not underestimate the degree to which the levers of liquidity are pulled by these basically uninformed people, or possibly a combination of uninformed and just wishful thinking. A lot of people don't.
I wanted to follow up with you because, like I said, you nailed it. You called it almost to the letter, and I wanted to first of all congratulate you on making such a great call. And how has that affected you and what you're doing at this point? As far as your analysis, what is your analysis showing you right now for the remainder of this year and into 2016?
Yeah. The general parameters of the forecast I made in the fourth quarter are still operative. I think that what we've seen so far matches roughly what I was looking to see. The end of the first quarter and before the end of the second quarter and start of the third quarter as a crisis window where the stage for higher turmoil would be set. We had Greece begin to really rock the market starting in March. That dog and pony show was for probably about 3 months a daily headline affair where negotiations would go on. The possibility of an agreement would be announced. Either one side or the other would make that salvo, and then all of a sudden the next week it'd start all over again. Like 3 weeks in the future, Greece is going to have to make a temporary payment, facility payment, and lo and behold, we're facing a possible Brexit, and then Ukraine being more of a hot proxy war, and then escalation in the Middle East, and the currency war factor, and the intentions going on with China, and the rise of all of the alternative systems that China and Russia, the rest of the BRICS, and other countries are putting all together. All these things were the context that we've moved through in the last 6 months or so, setting the stage for a lot more turmoil and a higher appreciation of risk, and that's where this year has been defined. And I figured that all this stuff would probably happen as a precursor to some kind of a market event where we'd see an equity markets correction, and we just went through that. It probably will rear its head again in the coming weeks, but it's going to be kind of pivoting on what the Federal Reserve decides to do. Early on, my formal forecast was looking at the situation and coming to the conclusion that the Fed would probably be willing to risk the damage associated with trying to reclaim their credibility by doing at least one interest rate hike and pretending that that was a normalization effort, but knowing all the while that that would pull asset prices down and create the possibility of turmoil to the extent that they might even have to launch a new form of QE, particularly if the economy was turning down. Well, we have the economy worldwide now turning down. The volatility that we had in the last 2 weeks is pretty high, but it wasn't big enough, in my opinion, to create the conditions for the Fed to publicly have it clear to do a QE4, even though at some point they're probably going to have to do that. And then you add on top of what's been going on with Chinese liquidation of U.S. Treasuries. They've liquidated over $200 billion worth of U.S. Treasuries, which is in the neighborhood of 17 or so percent of their holdings of U.S. All of their entire U.S. bond portfolio, above and beyond just Treasuries. So the conditions are such that the bond market liquidity as it exists now is almost half of what it was 2 years ago in terms of organic demand for U.S. Treasuries, and that's a huge problem. We have this ongoing need to finance the federal government, and the debt interest payments, and the normal functioning of the bond market in and of itself is at risk at this stage, and has gotten there because of this artificial demand that's been created by the QE programs and the subterranean QE that's still going on. All the interest from the position of the $4.5+ trillion balance sheet that the Federal Reserve holds generates income, and they roll that income into new bond positions. They don't, it's not some kind of sterilization effort. The QE of yesteryear still is with us. So all of that said, I think, looking forward, it's a little bit hard to determine whether or not we're going to have a second wave of this correction that we just went through, because it's going to depend on the degree to which the powers that be feel bold enough to risk the showcasing of the normalization effort that's pure propaganda and nothing more. I think they're probably going to try to do it. I mean, that's what we're getting out of Jackson Hole last week with all the public presentations, particularly Stanley Fischer, the vice chair of the Federal Reserve. The signaling that's coming out of the establishment is that they want to still do a September rate hike. And the market participants don't think of it that way. I mean, in this correction that we had over the last 2.5 weeks, we went from expectations of about 50-some-odd% of the people that Bloomberg would poll, as well as looking at the various ways that you can measure expectations in the short interest market and in the credit markets. They give you an indication of where expectations stand for the next possible FOMC meeting and the rate hike possibility. And we went from over 50% to now 34% expecting that we're going to see a rate hike in September. So the market is definitely ratcheting downward their belief that the Fed's going to raise rates. And I think the Fed might actually try to do it, though, in spite of all of this. And whether it's September or December, who knows?
I don't see it. I don't see them doing it. I mean, and if they do, Eric, I mean, it's not going to. We're only talking about 0.25%.
Yeah,
and that's what all of this jawboning by the Fed is about. Is 0.25%. and everybody gets all
yeah.
leap. Everybody gets all out of their mind over one quarter of 1%. And
but understand that it's in the eyes of the central planners of the Federal Reserve. They're trying to set expectations that the policy orientation would have shifted, and that on a going forward basis, it wouldn't be just 0.25% that they'd launch initially, but that the trend has changed. And a great deal of what powers Wall Street is just trend expectation, particularly in our money-chasing momentum world where there's so much money under management that basically switches on and off depending on what the perception of a trend is. And that's what they're trying to target. It's the change in expectations, not only of the hedge fund monkeys that chase momentum, but the pension fund managers who represent huge buyers, or at least traditionally, you've represented huge buyers of organic demand for treasuries and sovereign wealth funds and other central banks, in fact, because, they take down treasuries and hold it as part of their reserves. And that's, in fact, what is the underpinning of the dollar reserve standard, is all of the bonds that are in the central bank coffers. That's what they're targeting. They want the bond vigilantes to never show up. They want people to have the expectation that we're going to have a bond market that's moving in a direction of normalizing, as opposed to what only 2 years ago were 400-year lows in interest rates because of a level of manipulation that has never existed in humanity's markets ever. I mean, the distortions that the central bankers put into markets worldwide were epic. And because of that, they're now stuck.
Yeah.
And I totally sympathize with what you're speaking about, because in the grand scheme of things, that first 25 basis point move will probably not be followed by other moves, because the economy is going to roll over and the stock markets are going to suffer, and on and on. That's the reality. But what I'm suggesting is that when you zoom up to the 50,000 foot level and put your mindset into the mind of a Janet Yellen and try to figure out what she's thinking, it's the targeting of expectations. It's their attempt to change the way people think about where the direction of the interest rate paradigm is going to move, and also their constant jawboning of trying to basically speak a game that supports the notion that the economy is healthy, which is, we all see through that.
But at this point, I mean, is their MOPE, their management of perception economics, is it working at this point? Because from my perspective, it's not. I mean, you just said that there was a 16-point drop in the poll numbers that Bloomberg took prior to Jackson Hole and just after Jackson Hole. That's a big number. A 16 percentage point drop is a big number. I mean, it doesn't sound like it's working.
Yeah, I think more people are skeptical of any notion that the interest rates will be hiked anytime soon, and I think that that's the right perspective to have, because even if, we're kind of splitting hairs, because even if the Fed did do something just for show, it's completely irrelevant.
Exactly.
The only relevance it would have is maybe speeding up the process by which you have corrections, which in fact shape what the Fed would do next. And that's really, when getting back to your initial question, that's the tough parameter, the variable to wrap one's arms around and try to define exactly what will happen and ascribe some probability of that future outcome coming. And timing as well too. I laugh. Greg Hunter interviewed Craig Turd Ferguson over the weekend, and Craig was reiterating the long-time Wall Street adage of, well, if you ever give a forecast, if you stick a number out there, don't put a date on it, or if you put a date, don't put a number on it. I'm crazy enough and bold enough to actually go for both. And part of the reason why I do that is because it's not so much that I'm trying to, have bragging rights if I get something right, but the exercise of trying to forecast in that vein sharpens, at least in terms of how I work, the work that I do, in my thinking process. And I don't believe that we're going to see the quote-unquote big one in terms of a stock market and bond market correction in 2015. In fact, I'm actually kind of worried that the correction we just went through blew off enough steam and made people enough complacent that we won't see further declines. I mean, the Federal Reserve dumped something like $26 billion into the market through repo efforts last week. And that's a huge amount of money. And that's the reason why the stock market turned around, combined with what I suspect and cannot prove, but see the footprints of in the FX market of a gigantic amount of yen being dumped into the dollar market to convert it into dollars in the purchase of assets in the United States stock market. And what I think may have happened last week was some subterranean currency swap between the Federal Reserve and the Bank of Japan. And then, both, and how that would work is both central banks would electronically, quote unquote, print up X amount of money, call it 50 billion, whatever, and swap dollars for yen in their respective clandestine balance sheet that's not formally reported because they intend to reverse these transactions some 30 days forward or what have you. And that these kind of operations are the kind of things they pull out of their pocket when there's an emergency that they can get away with not showing to the public. And if you look at the exchange rate between the dollar and the yen over the course of last week, is just absolutely fascinating because you had these giant moves, and they corresponded pretty well with what happened with the stock market cycle and the bounce back. So I think between that and outright and formally publicly declared reverse repo actions in the marketplace for the Fed, we had basically this correction stalled and turned around last week. And these are the kind of efforts that on a short-term basis are still successful because the participants in the market haven't really given up the ghost yet. They still believe that the Federal Reserve and other central bankers have their back, that they will be successful in rescuing markets when markets decline, and that they're still willing to participate in this charade for a short-term gain. And because that sentiment is still there, I don't think we have the conditions yet for the markets to completely get so turbulent that they overwhelm these central bankers of the world, because the participants are still willing to dump money after bad. And, we haven't gotten to the stage yet where confidence is shaking completely to the root in what I call the conventional finance world, where 95% of money under management exists under the guidance of people who are, by definition, suffering under the groupthink of this conventional finance world. They don't read Zero Hedge every day. They don't look at alternative sites like the Daily Coin. Their way of framing reality is via the Wall Street Journal. And
you're right. I don't mean to laugh like that, but you're right.
And until such time as conditions change in the marketplace that are strong enough to make enough people second guess their assumptions, you're not going to have a mass panic. And even though the conditions fully justify a mass panic, because the rot underneath the system, particularly in the bond markets, but stock market as well, is there. And I think my operating assumption was that QE4 was going to be announced at some point after we have significant market turmoil. And that was my formal forecast that I established back in the fourth quarter of last year. And the time frame that I identified in terms of the prequel crash, market turmoil window beginning at the end of the first quarter and moving through the year, and then probably having at least one stock market correction of size before we even get to that period of high probability historically of September, and then October secondarily. I mean, as a footnote, it's actually interesting that September is really the month of highest probability for crashes, not October, even though we've had two really big ones in 87 and 1929. So now, looking out into 2016, I think that at some point we will have the big one, and we will have 20% plus down move on the S&P 500, interest rates backing up 200, 300 basis points on a 10-year for the Federal Treasury. Those kind of moves are the kind of things that would make what happened last week and the week before pale in comparison. And maybe you have $5 trillion or $10 trillion even, if you had a super large 2008, 2009 type of scenario in excess of $10 trillion worth of capital worldwide going up into money heaven.
And,
in order,
if you can see this, and I can see this, and if you think that the treasuries, the 10-year treasuries in particular, are going to back up, 200 to 300 basis points, which is 2 to 3%,
mm-hmm.
that's going to put them negative from where they're at currently. That's going to put them very negative. And
for people who don't understand the mechanics of bonds, when you have interest rates going up, the price of the bond goes down. And then if you're holding the bond because the price is going down, you have a capital loss.
If this can be seen through your analysis, Eric, can't the Chinese and the Russians see it? And I'm not trying to take anything away from your level of intelligence or your in-depth analysis. I'm not.
No, they got plenty of people who are smarter than me.
Well, I'm just saying. I mean, can't they see this as well? And do you think that may be fuel for the fire on why China has elected to dump 17% of their treasury holdings?
Yeah, that is definitely part of their thinking. They're diversifying away from the dollar. And now that they have the institutional frameworks with over 30 bilateral trade relations for currency swaps of the yuan or the renminbi, better said, for international trade, and their replacement parallel system for World Bank / IMF in the form of the AIIB Bank and the New Development Bank, formerly known BRICS Bank. All these kind of things fit into that picture, and they are preparing for mass turmoil and just long-term sound planning on a decades-based, forward-going basis. So, they see what I see. They're aware that no reserve currency status has ever lasted for, in excess of 50 years or whatever. I mean, historically, and in fact, paper fiat currencies all die. They historically have all died. There's never been an exception. And the dollar is
no exception.
Benefiting. The dollar benefits to some extent just because of the fact that we've never really had a global reserve currency and there's no alternative. So it's had a longer lease on life than what has typically been, even in the case of the pound sterling, when the sun never set on the British Empire. I mean, the way in which the dollar dominates the international financial markets is an order of magnitude even bigger than what the pound sterling did in the day of the height of the British Empire. So we're setting up towards a lot of things coming to a head. The ability for the Fed to postpone and kick the can down the road has an expiration date, and I think that expiration falls in 2016 in large measure because there is a shift going on in terms of the confidence in the underlying credit of the United States. I mean, the reason why the dollar and our bonds are still getting the bid that they get is because every other country in the world that is a possible candidate for safe haven status flows is nowhere near the condition of the United States, and that only speaks to the United States being best house in a bad neighborhood, as the analogy goes, or what have you.
And speaking of which, that's why we're probably seeing all the gold and silver flying off the shelf. Is this loss of confidence, and over the course of the past couple of weeks, in particular, I've asked people about new customers. I spoke with your colleague, the Doc, who has Silver Doctors and SDBullion.com, and I asked him about new customers, and I also spoke with Bill Holter last week. He still has an agreement with Miles Franklin, and he sells bullion for Miles Franklin, even though he's not working there anymore.
Right.
And both said that there's been an explosion of new customers. And that, to me, that speaks in volume to what you were saying as far as this loss of confidence. And this brings me to my next question, Eric. And it says, we're already seeing 90% silver coin going no offer. We're seeing the Royal Canadian Mint. They cannot produce or will not produce maple leafs and 10-ounce bars. The U.S. Mint, as we all know, they are in dire straits as far as being able to produce silver eagles, which is the number one selling silver coin in the world. And gold is beginning to fly off the shelf at an ever increasing pace. How soon do you think that it'll be before gold and silver both go no offer like the 90% coin?
It'll be a very, very long time before gold and silver go no offer on a wholesale basis, and what you can get out of comics, for example. And you can look at the example of 2008, 2009, where you had kind of a shell game going on with comics inventories and people trying to get delivery out of comics, and sometimes it would take up to 6-9 months to get significant silver in size. Jim Poplava, who's a financial commentator and analyst, and owns a boutique investment house in San Diego, talked a lot about how during those periods of time he's trying to accumulate a ton, literally a ton, 2,000 pounds worth of silver. And it took him 9 months to get it coordinated in part through Northwest Territorial Mint, and Northwest Territorial Mint was trying to source it out of the COMEX. And people would say, "Oh, there's no shortage. You can still get 1,000-ounce bars." But the reality was that when you wanted to buy something in size, you had gigantic wait periods. I mean, 9 months to try to accumulate silver is ridiculous.
Yes.
And at some point during that crisis, even the premiums on a 1,000-ounce bar were approaching 40%. I mean, that's unbelievable. I mean, people know about how Silver Eagles got 80, even 100% premiums in the worst window of that crisis. And that's a form of market failure that, though it isn't no offer, it's for all intent and purposes speaking to those kind of conditions, because premiums like that are sky high. So I think that we can see something like that pretty easily in the retail sector with even just a modest amount more increase in demand right now. I mean, only, 1.2 or so % of investors in the United States hold precious metals. And that's including, GLD and other paper forms. Very few people have exposure in North America to precious metals, and it wouldn't really take much more to put so much pressure on a system that the kind of things that we're seeing now will be looked at fondly as just, inconveniences. But the bottom line is that I think that we would nevertheless likely have to see some kind of phase shift, a point of punctuated evolution where all of a sudden a whole heck of a lot more people come to the market over the course of just 1 month, because some huge psychology shift has happened, and we have not seen that yet. The closest thing we've come close to that was when QE2 was leaked by Bernanke at Jackson Hole and then formally announced, and that was basically when gold got all the way up to 1,920 some odd on an intraday basis as its peak back in 2011. So, we didn't have no offer or gigantic premiums back then because the powers that be weren't playing the games like you just referenced with the mint shutting off production and so forth. They still were playing ball. So, there's enough metal out there to prevent going no offer on an across-the-board basis. And what you see in the 90% is just a factor of the 90% just being so small in supply to begin with because it hasn't been manufactured for so long.
But you referenced a shift,
and that shift will come.
That shift is coming. It's built in, and that shift is going to be when China formally begins pricing and selling futures and offers on the international market through the Shanghai Gold Exchange, the same as the COMEX. Same as the
That'll
LBMA.
still be an evolution, though.
It will be an evolution, but it will be a change. It will be a shift, and there will be a whole new group of people that are coming in to the markets that are currently not in the market
Yeah.
And they're going to start draining even more because, as you and I both know, and the audience is well versed in the fact that the Asian community loves gold, they love silver, and they're going to get it all. They're going to get all that they can, and that's what I see. And that's the reason that I ask about it going no offers, because when China, which they've already formally announced that they are going to start the pricing mechanism in Shanghai this year. This year is running out rapidly. And
yeah, but again, Roy, you need to understand that particular exchange and the mechanics around it and the change in the flows of gold and silver are not going to be the kind of 1 month transitional bomb dropped on the complacency of the marketplace such that it creates this kind of phase shift punctuated evolution that is powerful enough to wipe out inventory big enough to the point where things would go no offer. That's just not going to happen. What will happen, and this is where your thesis is correct, is that the transition towards a more physical-based market discovery exchange system that sucks away attention from the parasitic nature of the comics and the LBMA towards a more real market will, by definition, make more physical product, more gold and silver in physical terms, define the price discovery mechanism, and therefore dilute the power of the paper pushers to manufacture supply, bomb the market, seed the market over long periods of time. So either you have, respectively, the big down day moves or just the never-ending water drip torture of supply coming into the market in paper form that keeps a lid on prices. That, particularly the latter, and over time create an incremental evolutionary increase in physical demand, which will take away power from the paper pushers, and as a result, the price of gold and silver will drift up higher. Obviously with fits and starts and volatility and all that stuff. It won't be a straight line, but it's not going to be something that would create a no offer scenario.
Now, what about? I just read an article. I think it was at marketupdate.com that China, over the course of the weekend or the past, over the course of the past week or so, has decided to price their gold and their gold reserves at mark to market. In other words, spot price. How is that going to? How do you see that affecting things going forward? I mean, that makes a big difference, or does it not?
Well, it makes a difference in terms of the reserve position that they state. And so, to draw the analogy of the United States, I think we're still booking gold on our formal treasury reserves at $43.50 an ounce. And, if the United States were to suddenly declare the Fort Knox and New York Fed depository gold, never mind the fact that a lot of that's already hypothecated to the moon, and it's not all, there.
It's not all there.
But, that would increase the perception of the soundness of the reserve position of the United States vis-a-vis its paper currency that supposedly is backed up by all this gold. So it would, likewise in China's case, increase the veracity and confidence in the renminbi. But in terms of an impact to supply and demand of physical movement and, in turn, price of gold and silver, it probably won't actually make a big deal. The best it will do, most likely, is just increase the perception that, anybody who says gold is a barbarous relic needs to have their head examined. Central bankers obviously care a lot about gold and silver, including the United States.
Yep.
And it isn't just that, as Bernanke said, by tradition that central bankers hold gold. There's a very sound reason for it, and people like Stanley Druckenmiller, who is, a poster child for conventional finance thinking, as I was describing before. This whole conventional finance money management world is going through this kind of evolutionary process where one by one, the rats jump ship. They go and say to themselves, well, I don't think the Fed's going to have my back anymore, the central bankers in general, and that this lunacy has got to stop. And, that's where actions like what China is doing in terms of the definitional parameters by which they, declare gold's value, begins to shape and enter into the marketplace of financial ideas, such that it's a big mosh pit and everybody's perspective slowly changes in a conventional finance world. I think that's the transmission mechanism by which it actually has an impact on the market.
That's the reason that I ask, is because it's going to seep into people like Druckenmiller and the people that he hangs out with. Right. And all of those types of conventional finance people are going to look at that and go, why are they doing that?
Yeah. That and also subsequent declarations of gold holdings. I mean, in 2016, particularly given the fact that the IMF decided to urinate on the legs of the Chinese political establishment by saying, you're not welcome.
You're not welcome.
It isn't a coincidence that the Chinese devalued the renminbi immediately after. I think it was 2 days after they started that whole cycle of devaluation, and even got away from them to the point where it went further than they wanted to. Those are the kind of things that'll probably happen in 2016 as well, where China will come out and do another, maybe 1,000 metric ton addition or what have you to their declared holdings of gold, and that will move the market. They didn't do it this time around, in part because I think that, and this is just speculation on my part, but it was very clear that the Chinese establishment was having very productive discussions with the IMF, and that by all indications, China was reasonably confident that they were going to get a position within the SDR basket this year. And the United States freaked out about it, and word came out from upon high and landed on the desk of the leaders of the IMF, and they turned tail and basically changed their mind. And as a result, because China, in playing along with their game, I believe that they announced only 604 metric tons purposefully to play nice with the IMF and the Western establishment, expecting to be paid back with entry to the SDR. It was kind of a reverse logic to some extent from the way I was thinking that they would play their cards. I mean, early on, I think going back even to 2014, I had forecasted that China would most likely, with the highest probability, make that announcement in July, and I got that right. The timing was right. It goes back to what we talked about with Kurt Ferguson. If you're going to make a forecast, only do one parameter, not two. But they did not come above Germany and below 4,000 metric tons in their declaration, which is what I expected them to do. They clearly have far more than that. Yes. Anybody who follows the gold market with any degree of closeness can see this. I mean, they produce about 400 metric tons of gold every year from their domestic mine production, and 98% of that goes to the central bank. So in 2009, they made a formal gold declaration of 1,054 metric tons. And if you just do the math based on just what they produce internally, I mean, they would be way more than 1,658 metric tons. I might be wrong by 1 or 2 tons. I'm not sure if I remember that correctly, but I think that's what they declared.
Now, I want to ask you also, Eric, and then I'll let you get back to your afternoon. Jeff Nielsen, I spoke with him about 2 weeks ago, and he said, if you go back, China made two gold holding announcements. They made the 600, and then they came back a few days later and announced that they picked up another 19 tons for their official gold holdings. Now, Jeff Nielsen believes, and it makes sense to me, that the 19 tons was their official monthly purchase from the open market, because that's a required announcement. You have to tell the world what you've done, what you've purchased on the open market, because the central bankers around the world, they hate gold, they don't use gold, but they want to know who's got it and where it's coming from. So,
well, one quick correction on it. It's not required per se. It's that if they want to formally declare what their reserve holdings are, they're encouraged to, so to speak. But, as you can see, even just by the fact that 5 to 6 years passed before they finally made another declaration. I mean, it just goes without saying that they don't normally do make declarations. And that's what's interesting about what they did and why Jeff Nielsen's observation is important, because it definitely was approximating what they formally accumulated on a monthly basis, probably understating it too, because frankly, many a month has gone by where even just the outtake on the Shanghai gold exchange is just a monstrous figure. I mean, even sometimes 3 digits in terms of tonnage. So I think what that is likely all about is that they're setting the stage for justifying a secondary, or in this case, a third declaration sometime in the future, possibly 2016 or probably 2016, where they dump another 500 metric tons to their number and leapfrog into something that the market considers to be important. I mean, for all we know, some people in the Chinese establishment probably thought, 604 metric tons is going to raise eyebrows and be a confidence booster. And in fact, it was kind of the opposite for the most part.
yes.
And if they come back quicker, instead of waiting 6 years to do a formal declaration, the fact that they did this on a monthly basis just recently sets the stage for that. I think that that's what they're doing.
What Jeff was saying was that he thinks that, as Russia has been doing for a couple of years now, making their monthly, we purchased another, 12 tons of gold this month or last month. And they think that, and Jeff's thesis is that that China's going to start doing that. And I tend to agree. And if they do, and we're going to find that out here pretty quick, within the next 10 days or so, we'll know if his theory is correct or not. And if they do that, that's a game changer. I mean, if they're going to start, if they make back-to-back monthly declarations, even if they're small amounts, if it's 20 tons or 15 tons or whatever, not 600, then the door's wide open at that point, as far as, well, we accumulated another, 17 tons this month. And then the next month, well, we accumulated another, 18 tons. And then 6 or 8 months from now, in that second quarter of 2016, then they can come back and say, we actually have X number of tons. And
yes and no. I mean, do the math on this. Let's say that it's 20 tons per month, 12 months, that's 240 metric tons. 240 metric tons divided by 1658 is not a huge addition on an annualized basis. It's in the order, roughly, it's twice the accumulation rate of what they claim happened between 2009 and their last declaration of 1658. And that's not earth-shattering in terms of magnitude. So, this monthly declaration can actually be enforcing the status quo complacency if it stays in a declaration for public consumption purposes in a neighborhood of a 20 metric ton per month consumption rate.
But what if 1 month they come out and say, well, it's not 20 tons, it's actually, 800.
We took down 150 metric tons this month.
Yeah.
That very well could happen. The fact that they're laying in the expectation and precedent for probable monthly disclosures can just give them the lever by which they can elect to pull and then have that kind of power. I mean, it's kind of interesting, actually, now I think about it and the way you just framed it, because it gives them the directional lever of dialing down expectations or dialing them up as they choose.
As they choose. And the thing is that they are, from the understanding that I have, and I'm in contact with Jeff Brown, who lives in Beijing, interviewed him a number of times. He has confirmed that the Chinese are really, they are very, very upset over the SDR deal. they're really mad about that because
They were hosed.
and they should be, because they did everything that they were asked to do. They played fair, they played nice, and what happened? The Western world slapped them in the face again. So it wouldn't surprise me at all if they come in and do, you know, a 75-ton month, and then a 50-ton month, and a 100-ton month on gold. That wouldn't surprise me in the least, because, like you said, I mean, they now have the lever. They have the gold lever in their hand, and within the next few weeks, they're going to have the pricing mechanism in their hand. So they have a lot going on, and the Western world is blowing them off and going, well, you know, it's those Chinese, you know, they don't know what they're doing. Well, actually, they own us. That's what they know. And the 17% in treasuries that they just dumped, I think that there's more of that to come too.
Yeah, they're definitely going to continue diversifying away from the dollar and dumping treasuries. No doubt about that. Yeah, and even the context of this IMF development needs to be put into perspective historically, because a lot of people don't even realize that back in 2008, 2009, the Obama administration was perfectly willing to have China do a renegotiation of the voting rights within the IMF and inclusion of the renminbi into the IMF's SDR basket. And that's part of the reason why China is, in fact, as disgruntled and willing to launch the AIB and the efforts that they've done with the new development bank and so forth. All these things where the ball began to roll on those institutional shifts 3 years ago. And the reason why it began 3 years ago is because the IMF in the United States had hosed China before this summer. It was something that has been promised to China for now better part of 7 years, or 6 years at least. So it's a big deal. We talked as well in the January program that we were referencing earlier in this broadcast about how the precious metals community kind of got lost in the weeds when it came to trying to analyze why China is courting the IMF, and people were speculating that, they're going to just develop their alternative systems and drop a bomb on the IMF and the World Bank system and the Bretton Woods institutional framework. That's not the way China rolls. They look towards 100-year time frames for their strategy. They take their time and they're very patient about building out multiple systems and multiple strategies. And even if they don't get into the IMF SDR basket on a going forward basis, it's really not going to make much difference. They're building what will ultimately, in the long run, become the institutional frameworks and trade relationships that'll have the dollar reserve currency status wither. It may not 100% die. It'll certainly take a long time for a 100% destruction of the dollar, and even on a lesser extent, reserve status going up in smoke. And I'm not in the camp where people quite often will see it as being like some kind of over weekend or over month kind of development. I think it's going to take more time than that.
Well,
but it's going to happen.
It is going to happen, and I hope that you're right. I hope that it does take, more than a weekend or more than a month, because there's stuff that I need to take care of before that happens.
Yeah, exactly. I mean, we actually are. We love to bitch and complain about how things are so massively manipulated and the markets are a farce and whatnot. But in one way of looking at it, it is a blessing in disguise, because the other side of this pending crisis is not going to be pretty. I mean, a lot of things that we take for granted can, in fact, just evaporate. Constitutional republic and the freedoms that we, are under constant duress and seeing evaporate could just completely disappear, and we'd have martial law scenario if we had a market crash on the order of the Great Depression. And the odds of something like that happening are high enough that should scare the hell out of people. But most people are not aware that something like that can happen, because they're not aware of the degree to which the financial relationships underpinning everything are just rotten to the core.
They are
and
right.
the manipulation have destroyed markets. I mean, there's no real price discovery. When you, the most important takeaway point about manipulation is that if you destroy the very basis of money and its signal, and interest rates are nothing but the price of money, then you destroy everything. Every market, and Western markets for sure, but even beyond that, I mean, all markets are now operating on distorted price signals, and it distorts everything. It creates bubbles everywhere.
Yep.
Not yet in gold and silver.
Not yet. On the downside, there's plenty of bubbles.
Yeah.
Big bubble on the downside of gold and silver. But this too shall pop, and when it does, look out above. So, but anyway, we've been speaking with Mr. Eric Dubin, who is the managing editor at thenewsdoctors.com, and I certainly appreciate all your time today, Eric.
It was great talking to you, Roy. There's always a lot to talk about, and it's fun chatting with your audience.
There is, and we will do this a heck of a lot sooner than any 8 months. I can assure you of that. I'll get you back on here before year end, and we'll wrap this thing up.
Anytime.
All right, buddy. Have a good afternoon.
Thanks.